There are moments in history when systems don't collapse. They shift, quietly, no alarms, no dramatic announcements. Just subtle pressure building beneath the surface. Until one day the rules are no longer the same. Oil climbs, shipping costs rise. Markets begin to tremble, headlines grow louder, investors grow nervous, but beneath the noise, something far more important is happening. Money is moving, not disappearing. Not evaporating, moving. And when capital moves at scale, it leaves clues. For years, the global economy floated on a single invisible force. Cheap money, low interest rates, endless liquidity injected into markets to keep growth alive. Asset prices inflated. Speculation flourished, debt felt harmless. In fact, debt felt normal. But liquidity is not strength. It is support, and support can be removed. When geopolitical tension rises, and debt levels are already heavy, fragility becomes visible. Energy prices don't just affect fuel pumps, they shape transportation, manufacturing, agriculture, global trade. Energy is the bloodstream of modern civilization. And when the bloodstream becomes expensive, the entire body reacts. Prices adjust, margins compress, consumers hesitate. Inflation doesn't return as a headline, it returns as a structure. The first wave of inflation was called temporary. A side effect, a phase. This time, the forces are layered. Energy pressure, strategic defense expansion, supply chains relocating closer to home, higher borrowing costs reshaping corporate decisions. Governments now operate with far less flexibility. Debt burdens are heavier, stimulus carries consequences, and when artificial support fades, markets are forced to rediscover fundamentals. This isn't destruction, it's repricing. Companies that thrived on cheap capital begin to feel pressure. Assets tied to real demand begin to regain leverage. The system does not implode, it rotates. Every major wealth shift in history follows the same emotional arc. Uncertainty, fear, liquidation, then accumulation. Retail investors respond to headlines. Institutional capital responds to positioning. When volatility spikes, many rush for safety. But disciplined capital asks a different question. Who benefits from instability? Who gains pricing power? Where is spending expanding instead of contracting? Because crises don't eliminate wealth. They redistribute it, and redistribution favors preparation. As trust fluctuates, capital seeks resilience. Cash flow over promises, scarcity over speculation, tangible output over narrative. Balance sheets begin to matter again. Leverage becomes a liability instead of a strategy. Meanwhile, global debt continues to sit quietly in the background. Governments owe, corporations owe, consumers owe. When borrowing was cheap, the burden felt manageable. As rates rise, servicing that debt demands more income, more productivity, more discipline. Behavior changes, expansion slows. Spending becomes selective, capital becomes cautious. And caution creates filtering. Weak structures strain, strong structures consolidate. This is the reset few people recognize in real time. It doesn't announce itself. It unfolds gradually. Through subtle shifts in capital flow, through sector rotation, through quiet accumulation while others panic. The great wealth transfer is not a dramatic event. It is a gradual repositioning. A shift from excess toward efficiency, from speculation toward structure, from easy gains toward earned resilience. Those who react emotionally experience volatility as chaos. Those who prepare structurally experience volatility as opportunity. The divide forms slowly, then suddenly. History rarely remembers the fear. It remembers who positioned correctly when others hesitated. The shift is not coming, it is already underway. And the only real question is not whether change is happening. It's whether you recognize the direction of capital before it fully settles. Because once it settles, the opportunity narrows. And those who understood the movement stand on a different side of history.